Today, we're going to focus on different types of insurance that you can buy and why we do that. Before we get to that, however, we have to talk about the idea of risk. Think about this. What types of risks do you face on a daily basis? Do you just wrap yourself up in bubble wrap and never leave home? Life itself does have risks. So, how do we deal with these? Well, we have four major ways you can do this, and the first is to just avoid it. Nope, I'm never going to leave home. Think back to the example with the bubble wrap. That doesn't sound very pleasant, does it? Second, you can limit it. Okay, I'll wear a seatbelt when I'm in the car and never drive when it's raining and only drive during the daytime. Third, you can outright accept it. Well, if I get in a crash, I'll just pay for it. If my phone breaks, I'll just buy another one. And finally, four, you can share it. And that's what we're going to talk about today. So what is insurance? Insurance is paying another company to share the risk of activities that you undertake. Why do we pay a company to do this? Well, frankly, most of us don't have the money in the bank to cover a loss when it happens. What are some benefits? We can rely on the company to cover us if an insured loss occurs. If my phone is stolen, I don't have to pay the full replacement. If my house burns down, I don't have to worry about where I will get the money to rebuild. So 3 words you need to know. First is premiums. This is what we pay to purchase insurance. It's the bill. Second, deductibles, the amount we have to pay before the insurance kicks in. We'll get to this more later. And 3, coinsurance, the amount you have to pay against a claim. And again, we'll get to that a little bit more later. The first type of insurance we're going to talk about is auto insurance. As the name says, this relates to losses that involve your vehicle. In Georgia, if you have a car, you must have auto insurance. There are several types. What we usually see on TV for companies like Safe Auto in general is minimum coverage. This is liability only. It covers damages you cause to someone else if you cause an accident. It does not cover your car or your injuries at all. In Georgia, minimum coverage can be represented by this, 25, 50, 25. The first number represents bodily injury coverage for per person. The second number represents the total number for all hurt. And the third number represents your coverage for property damage liability. Again, this is for the people you hurt, not yourself. This does not fix you. This does not fix your car. Each of these numbers represents numbers in thousands of dollars. So it's $25,000 per person with a $50,000 maximum per incident in bodily injury liability and $25,000 in property damage. Now, obviously, this is just the minimum. You can buy more. I, for example, have 100, 300, 50, which means $100,000 per person with $300,000 maximum and $50,000 in property damage. This does not represent your total liability. Ultimately, if you cause an accident, it is your responsibility to make the other party whole again. That's why you can buy more. It is, again, your responsibility to make the other party whole. Now, the first type of insurance you can purchase for yourself is comprehensive or comp insurance. This covers you if you have a loss caused by theft, someone takes your car, animals, for example, a deer hits you while you're driving, you'll probably still need to file a police report though, or an act of God or of nature. Think if there's a flood, a tree falls on your car, a tornado flips your car, or something like that. You'll usually have a deductible. Now, the thing I want to point out is as you raise the deductible, that means you're willing to take on more risk. That means your premium will go down. So if I choose a deductible of $250, my monthly premium will be higher than if I go for one of $500. Collision insurance covers repairs for your car when you cause the accident. You'll probably have a deductible anywhere from $250 to $1,000 usually. You can purchase uninsured motorists or underinsured motorists. In Georgia, these are the same thing. This type of insurance covers you when someone else hits you and they're uninsured or underinsured. Now, while it's true they are responsible for making you whole, if they can't afford it, they can't afford it. Just think of the old adage, you can't get blood from a turnip. If you are hit by a 17-year-old driver who doesn't own anything and they only have minimum coverage insurance, but your hospital bills are $80,000, this is where your uninsured or underinsured motorists will come in. MedPay insurance covers medical expenses for people in your car regardless of who causes the accident. So somebody hits you and people have to go to the doctor, this helps pay. And again, even though it's the other party's responsibility to make you whole, bills do have to be paid right away, and this will help. In addition, you can also purchase road service, which is what you'll use in case your car breaks down or your battery dies, you get locked out, anything like that. Towing, get your car towed to a repair shop if it is not drivable. Gap coverage, if your car is totaled and is worth less than the amount you owe to the bank. This is really important. Let's say you borrowed $20,000 from the bank to buy your car, but your car gets totaled and they only value it at $12,000. Well, that gap insurance covers you there. And finally, rental car coverage. This gets you in a rental car while your car is in the shop being repaired. Next, I want to talk about homeowners insurance. Homeowners insurance covers you against loss from fire, theft, tornadoes, liability, things like that. You have to buy separate insurance for a flood from an outside source, such as a river overflowing its banks or an earthquake. Now, if a pipe bursts in your house, your homeowner's insurance will cover this. But if you live near a river and the river floods, the homeowner's insurance does not cover that. You need separate flood insurance for that. It covers both the building and your possessions after your deductible is paid. And it also covers you in the event that someone is hurt on your property. And it doesn't matter if you invited them there or not. Let's say someone's coming to your door to sell you something and they trip over a hose you have stretched across your sidewalk. You have to pay their doctor's bill. The homeowner's insurance covers you for this. Next, renter's insurance is very similar to homeowner's insurance, but it only covers your possessions, not the building. And this makes sense because you don't own the building if you are renting. The landlord should have insurance to get the building repaired. You don't want to rent an apartment or a house and not have renter's insurance. There's too often in the news, there's an apartment fire and people don't know what to do. If they had renter's insurance, the insurance company would pay for a hotel and pay to replace the clothes, furniture, whatever was in the apartment while it was being rebuilt. If you don't have renter's insurance, you're on your own to get your property replaced. The landlord is not responsible for your personal possessions inside an apartment if it burns down or something like that. Okay, health insurance, moving on. Health insurance covers you if you have to go to the doctor. Most people get this through their job, but if not, you can go through the marketplace and the Affordable Care Act, which is also known as Obamacare. Technically, it's required that you have insurance, and there's technically a penalty if you don't have it that you have to pay to the IRS, but as of 2019, that penalty was lowered to $0. So, although there is a technical penalty, you won't have to pay anything if you choose not to have health insurance. Now, the basic types you will come into contact with are a health maintenance organization, an HMO, and there are advantages and disadvantages to this. HMOs require that you have a primary doctor or a primary care physician, also known as a PCP, before you get any other type of service. This may mean delays in care if you need to see a specialist. However, you usually only have a low copay when you go to the doctor, so you know exactly what your out-of-pocket costs are going to be. Next, you can have a preferred provider organization or PPO. This gives you a little bit greater freedom in choosing your doctors, but you will have to pay for that freedom. You'll hear terms such as in-network and out-network more here. In-network doctors contract with your insurance companies to provide lower prices, while out-of-network doctors don't. You save some money by going with the in-network doctors, as you usually have a lower deductible and co-insurance costs. A point-of-service plan combines features of HMOs and PPOs, where you can still see out-of-network providers, but you are going to pay for that option. HMOs do not cover out-of-network providers, so this is the big difference between an HMO and a POS. Finally, a high-deductible health plan, or HDHP, lowers the cost of insurance by passing more of the cost to you. Remember, the deductible is the amount of risk you are willing to take on, so if you have a higher deductible, you're taking on more of that risk. Now, you can set up a special savings account called a health savings account with this, and you can put money in there tax-free, but you can only use it to help offset what you would pay that the HDHP doesn't cover. Now, if you're young and healthy and don't need a lot of medical services, this might be a good route for you, but you need to evaluate your own situation before choosing which route to go. There are, however, two things that health insurance doesn't typically cover: dental and vision. Dental covers teeth cleaning, x-ray, sometimes major dental surgery, depending on your plan. Vision usually covers your annual eye exams and glasses or contacts. Finally, I want to talk about life and disability insurance. Life insurance helps you pay for funeral expenses and gives your survivors money to move on if you die unexpectedly. Two types of life insurance are term. You're insured for a certain amount of time, usually 5 or 10 years, but this can be renewed. Or whole life, which builds up value as you pay into it, and think of it kind of like a very long-term savings account. And disability insurance. Disability covers you when you aren't able to work due to a disability. Let's say you fell downstairs and broke both your legs and can't work for 6 weeks. Your bills aren't going to stop, so disability insurance will help cover these expenses. So I hope this helps you better understand what insurance is and how it works.